Hello, and welcome to the Power Your Advice podcast. The Power Your Advice podcast is designed to bring financial advisors new ideas, why those ideas should be considered, and how to implement them into your businesses. This podcast is brought to you by Advisorpedia, the best place for advisors to grow their minds and businesses. This is your host, Doug Heikkinen. And today we're here with Matthew Gorelik, who's the CEO of Township Capital. Township Capital is a Los Angeles-based real estate investment manager focused on programmatic equity co-investments alongside best-in-class sponsors and institutional equity investors nationwide. Welcome, Matthew.
Thank you. Thank you for having me.
You built this thing out of thin air 5 years ago. Tell me about it and what do you guys do?
So thank you for having me. So Township Capital was organically founded by me about 7 years ago. And what it really was based on was working at an investment bank and doing a great deal of commercial real estate financing for best-in-class developers and owners of commercial real estate. And what we found was there was sort of this dislocation or archaic business model in which when you get to be as good as the top developers in student or senior industrial or whatever asset class it may be, that generally these are capitalized with an investment bank in a 90-10 joint venture. So what that means is the investment bank, let's use like JP Morgan or Goldman Sachs or Pacific Life or big pension funds, they put up 90% of the equity and the developers put up 10% of the equity. And that was fine maybe 30 years ago when real estate just wasn't as expensive as it is now. And so what we found was there was a sort of a hidden secret that this 10% was sort of syndicated out by the GPs, starting with friends and family and going from there. And so what Township Capital does is we institutionalize these institutions by bringing one investment vehicle to them, which is a Township Capital vehicle, and we provide a portion of that 10% in order to capitalize that deal. And what that does for them is, in turn, allows them to do a lot more deals. It allows them to have better cash flow, run their company better. And so we're there really to help that sponsor build their business. And so that idea that we started really investing in about 4 years ago has turned into, we've done 81 deals all across the United States. It's in the student sector, the senior sector, industrial, multifamily, some select hospitality, and we've been very successful doing it so far.
So there's a lot, the world's completely different than it was a year and a quarter ago. And with the commercial real estate industry kind of in flux, what's going on with it?
I mean, it's a pretty broad question, but really what we see is every one of these different sectors, everybody's obviously, it's been very uncertain and it's been very scary. What we found from our business is when you are investing in this type of commercial real estate, which is extremely large commercial real estate, when you're using very low leverage, meaning low debt. So the amount of debt we go to really caps out around 65%. And because of these institutions, and there's so much equity, those banks, especially now when you're seeing that the interest rates are so low, they're able to get very low interest rates and very low leverage. Means even in the worst of times, you can sustain a dislocation in the market because you don't have 80% debt with layers on top of layers of preferred equity or mezzanine financing, which makes things more complicated. This is generally speaking, the large companies that have low debt have gone through this period relatively unscathed. And what we've seen is for example, can go off on a tangent a little bit for student housing as one example, whereas it sort of has been getting a bad rap. On the tier 1 universities, which is what we have primarily invested in, we have found that kids do not want to live with their parents anymore and be in quarantine. They just can't do it. So most of our student is 95 to 100% leased and occupied. These are universities like UT Austin, Florida State, Florida, to California, to all over the country what we're finding is that if the student, if there's campus life, University of Michigan, if there's campus life, then the kids want to be there, regardless of whether they're learning online. They're still in fraternities, they're still on campus, there's still student housing.
That's amazing.
And really sorry, go ahead.
No, so kids just want to go to school, want to get away from their parents, and then when they graduate, they're moving back in with their parents.
Correct. And even more so, if you're a freshman coming into these campuses and they close the dorms down, they really still want to be there. So what do? They go to just off-campus housing. And so the demand for this type of a product has been extraordinary over this period of time.
You also deal with multifamily housing, and there's been an enormous shortage of it. What does this mean for you guys and investors?
So we actually just closed a co-investment with a company called Epic Investments. So they're about $20 billion of assets under management. And the large limited partnership is AIMCO, the Alberta Investment Management Company, which is a $120 billion pension fund. And these are to acquire multifamily assets across the United States in Sunbelt states. So Nevada, so Las Vegas, Phoenix, Orlando, Tampa, Texas. And what we have found is that already before the pandemic, there was a huge shortage of multifamily. So when you stop any type of building or sales velocity over the course of a year and a half, then you really, really lose a lot. So right now, the demand for multifamily housing is enormous as people upgrade where they're living, because as people are working at home and they're spending a ton of time at home, they're going to want to live in a nicer area. So these are sort of 80s, early 90s vintage that need full upgrades because the wireless doesn't work properly, there are no amenities, and so. So for us, we're really looking at these developers that are going into areas that where people have been moving to in masses, and really there's nothing for them to live in right now. And so when you acquire that, as leases come due, people move out, you upgrade the unit, and people move there, and you bump up the rents, and then all of a sudden you make that's more of an institutional size portfolio, and that's when the big investors like the Blackstones, Apollos come in and buy those units. So we see a huge opportunity for investors investing directly into large commercial value add multifamilies across the United States.
Do you find that people are moving to the same areas that's being reported widely around the country?
No, I really don't. I mean, there's talked about a mass exodus out of California, and we just, I mean, statistically, you just don't see it. There's been some that have come out of Los Angeles because it's really expensive to live there, across the United States, across California. But, you know, in my opinion, and this is just me personally, I think that the people that have moved out of New York City and gone to Florida, I don't believe they're going to stay in Florida, because I think that they're, and now that New York is opening up, and you know, the kids want to go back to their schools and they want to go back to their country houses or wherever that may be. You know, I think that we won't see a huge displacement in any specific state, because New York has so much to offer for so many people that people love to live there. And when they haven't lived there for a while, I believe they're going to want to go back. But at the same time, when you look at opportunity, Nevada, like the Las Vegas, you know, they're constantly building and hiring. And so there are people that are in, you know, different age categories that are going to want to move there. And I think for the multifamily, you know, when I was young, the dream was that you would want to buy a house, and people wanted to buy a house. But if you look at the younger generation now, there's much less of an appetite for people to own, and a much bigger appetite for them to rent. And so I think the multifamily in certain areas, independent of where they are, there'll be a big demand, and it'll be for years to come.
I'm of the view that many people who left where they lived and moved someplace where they thought was going to be great are going to wake up a year from now and go, what did I do?
I agree. And I happen to just be in Miami, and there were everybody that I was talking to that had been there during quarantine all enjoyed it. But as you know, as you go into the summer months where Florida gets really hot, you got to go somewhere. And these are the people that, you know, left New York City for the summer too. they're going to want to go back to those places. If they have kids, those kids want to go back to their friends and their schools and Broadway and museums and everything else, things that Miami doesn't have to offer or Florida doesn't have to offer, and that type of lifestyle. Same goes with people that were just going into Texas. People are going into, it's one thing to live there for a year when you're under quarantine, but when things do get back to normal, there is something about being home, and I think that people will come back.
Yeah, have fun driving around Austin. Senior living took a big PR hit during the pandemic, but demand has seemed to have held up. Is this a segment that you guys focus on at all? And if so, what trends should investors keep their eyes on?
So that's a great question. And we do own a considerable amount of senior living, and it's sort of, senior living isn't just, hey, it's all senior living. Senior living is categorized. It can be active adult is what they call it. You can say age restricted, and that's really multifamily for 55 or 60 years and older. Again, a huge demand for that. If you are older and you have been living in a multifamily with other age groups, that could be not like-minded, and they're up late or music's playing or whatever's going on, you're going to want to move into a place that is more like-minded in how you live and that lifestyle. That's one. Two, a large senior living, independent living, and those types of like closed environments. If you're, older people that haven't been able to see their kids and grandkids, it's depressing. I mean, they're depressed, they're sad. We've seen that all across the country, and people understand what that is. And so for those types of individuals, they're going to want to move in. As soon as things opened up in Florida, our senior living, the lease ups went crazy because so many people are flocking to these areas where they know if this does happen again, and there is another pandemic of some kind, and they're shut down, their life doesn't really change. The doors get locked. They don't get to see their family, but they have their friends. And listen, there's still like exercise classes, and there's a swimming pool, and there's tennis courts. I mean, it's a full lifestyle, and it's a way of life that's not going to keep you alone in an apartment depressed. And so I think for that way of living, and everybody can think differently about it, but we have just seen it statistically, the amount of people coming into senior living, true senior living housing, has been extraordinary over the past 60 days even. And we will continue to see that build and build as, people sort of think about what's happened to them over the year. How can they change? And how can they, and these are places that are all across the United States. So it's not like they have to move to Florida. It's not like they have to move. They're all over. So they can still live in the area that they're living in, but with other people, so they're not alone if this ever happens again.
This is great because you guys touch on almost everything. So let's move
Exactly.
let's move to industrial space. You're working on a project at JFK. Give me an overview of industrial space and about that project.
So this is with Triangle Equities, which is a partner of ours. The LP is the Michigan State Teachers Pension Fund, and we were thrilled to be able to invest in this project. It's the first multi-level industrial build on the East Coast, and the demand for industrial right now, because of how big Amazon, Lowe's, Kohl's, Walmart got, there have to be areas in which there is last mile distribution. So how do they get you the product? They need the demand. So we had four industrial sales with our partner CRG Clayco out of Chicago, where the underwriting was, we beat the underwriting by a lot, because the Amazons and Walmarts and those big boxes really need space, and so they'll pay anything for it. And I would say anything, but they will pay up for it. So this particular one is at JFK, and it's actually, it's not built yet, but it's probably 6 to 8 months away from being built. But there's already an offer for a large tenant that we can't disclose, but it's a large tenant that's coming in, and it'll be a very lucrative investment for us because of the amount of money people are willing to pay for that product right now, because it's just a massive demand, and there just isn't enough industrial out there to meet the supply.
Is multi-level industrial unique or just unique to this space?
It's unique because you can do more than usually industrial is just one large, box. This has, you can have offices, you can sort of, it's like one-stop shopping where you can put offices in, you can put even some retail in, there's a lot that you could do with a multifamily industrial, and you can have multiple tenants. So it's just a little bit different because it's going to be a lot larger for more of a condensed area at JFK than it would be for, when you're out in some, industrial park, that in the suburbs.
Yeah. Where's Township Capital going in the near future? What are you really excited about?
So we're really excited about continuing to find partners to expand our relationships with our partners. One of the things that we were unsure about was if there was a dislocation in the market, how would we do? Because when we started this, the real estate market and the stock market, everything's been fine. And you don't think something could happen to this degree, which it's happened with a global pandemic and a shutdown. And so we, out of all of the assets that we've invested in, which is a lot, we had no debt issues. We had no equity issues. We have just, it's a timing issue. So what we thought might have sold last year or even the beginning of this year that has been pushed back maybe a year. But when you have low leverage, low debt, you can survive that. And so for us, with a proven business model, we've had 10 round trips. So full, investing, build, lease up, sell. We've had 10 of those. Our IRR is extremely solid. And so now that we've had a proven business model, we're excited to now continue to build that bridge to connect individual investors and family offices into direct commercial real estate and to continue to grow. The multifamily business is a great business where individuals can invest directly into these deals and get a high single-digit cash flow with a really nice return with very low risk. That's a great opportunity for people to do this as yields and bonds continue to just stay low. And also, we think the student space, there's a ton of student that's out there for these big universities that are either needed to be upgraded or they need to be built. And as well as senior. I mean, there isn't an asset class that we see in real estate that we generally don't like, other than hospitality, which we're really not an investor in, and we really don't have any retail. So those are two assets that we really, not necessarily because we don't necessarily want to own them. We just haven't seen any deals that come that fit our business model. But for us, I think that as the stock market continues to go up, and I'm not sure what the stock market does. One thing I do know is that when interest rates are low and people start looking at transitioning maybe some assets out of the stock market because it's done so well, it will go into commercial real estate, and we're going to be taking advantage of it.
Yeah, that's a good segue for our next question. Is what advice you have for advisors who are considering this asset class for their clients?
I would say with the stock market at 34,000, with the 10-year treasury, the dividend on the 10-year treasury is higher than the S&P index dividend. You're going to see what's called a flight to quality. So people transitioning out of that into more stable return profiles. I think what we have to offer will outperform those dividends and the stock market over the next 5 years for sure. And real estate's really the oldest investment that's ever been around, and you tried and true. Making sure that you are invested with really good people with a ton of corporate oversight with these large LPs and using very low leverage, you're going to be able to get yourself cash flow, depreciation with an opportunistic return.
Matthew, we really appreciate you joining us today. Thank you so much for your time.
Thank you so much.
To find out more about Township Capital, go to townshipinc.com. That's townshipinc.com. Please follow us for all the latest updates on Twitter, LinkedIn, and Facebook, all at Advisorpedia. For everybody at Advisorpedia, our producer, Jakey Beard, and the Power Your Advice podcast team, this is Doug Heikkinen.